Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at BlackBerry.
If you find our talks useful, please consider subscribe, like, and comment underneath. And
before we get into today's stock, here is a useful tool for traders who want a more structured chart setup. VIP Algos is built for TradingView and gives you access to premium AI-powered indicators, clean visual alerts, market structure tools, risk-to-reward planning, beginner-friendly education, setup support, and a private members community, starting as low as $9 per month. If you are trying to improve how you read charts and manage trade ideas, VIP Algos can help make the process easier to understand across markets like stocks, forex, gold, indices, futures, and more. But please remember, trading is risky. VIP Algos is for education and chart analysis only, not financial advice. It does not place trades for you, manage your account, or guarantee results. Always manage risk, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
right, so diving into this, it's actually pretty wild. The foundational code that's basically keeping NATO communications secure and the operating systems, preventing autonomous vehicles from crashing, it belongs to the exact same company that made that physical keyboard phone you probably, threw in a drawer over a decade ago.
Or one every newsstand.
Exactly. We are basically trying to figure out how a brand most people mentally filed away in the history books just quietly engineered this, profitable software near monopoly.
And right under Wall Street's nose, too.
Literally. I mean, if you look at your screen right now and pull up a 90-day chart for BlackBerry, you are going to see the staggering reality. Like a massive 131% return.
It's huge.
And year to date, we're looking at a surge of over 108%.
Which is just, incredible.
So as a risk-aware investor, I have to ask a very skeptical question right out of the gate. Why is a legacy hardware brand suddenly trading some high-flying AI infrastructure stock?
Well, it really is kind of the ultimate market paradox.
Yeah.
The reason it's trading like this aggressive software growth engine is because that is precisely what it has become.
Okay.
Like what you were seeing on that chart is the market violently waking up to a complete transformation.
A total pivot.
Exactly. For years, the narrative was just bogged down by smartphone nostalgia, right?
Sure.
But behind the scenes, they systematically pivoted away from hardware completely.
All right, let's move into the wealth building context, because understanding that fundamental pivot, that's really the only way to figure out if you should actually allocate capital here instead of just treating this like another fleeting meme stock rally. So how does a transition this extreme actually fit into a cautious portfolio?
Well, if you're building long-term wealth, you really have to look past the ticker symbol's historical baggage.
Yeah, ignore the old phones.
Exactly. What we are witnessing is a fundamental re-rating of the stock.
Yeah.
The market is slowly realizing that this is no longer a messy turnaround story.
That part's over. Completely over. Today, this is a pure software infrastructure play. They basically built their entire forward-looking thesis around safety-critical systems and digital sovereignty.
Which is huge right now.
Massive. We're talking about the embedded code that runs modern connected vehicles and the secure communications networks that, the highest levels of government actually rely on to function.
Okay, but I look at this and I have to push back a little on the mindset required.
Yeah.
It is an enormous intellectual leap for the market to make. So the practical question for you listening to this right now, how does this actually fit into a multi-year wealth building strategy? Because it's just incredibly easy to get caught up in the FOMO of a 131% 90-day return and completely forget about risk management.
Oh, absolutely. It fits because of the runway, though.
Yeah.
The real wealth building opportunity here isn't trying to capture the next 20% pop next Tuesday.
Right. It's not a quick flip. No. It lies in the 3 to 5 year runway that the company needs to fully monetize their new partnerships and their massive automotive royalty backlog.
A 3 to 5 year timeline.
Exactly. When you transition from selling consumer hardware to licensing deeply embedded software to method manufacturers, the revenue, it doesn't just show up overnight.
Right. The sales cycles are brutal.
Incredibly long. It requires a lot of patience. But once those design wins convert into actual vehicle production, the cash flow becomes highly predictable and recurring.
Which is what you want.
That's the exact kind of visibility that anchors a long-term portfolio.
Now let's look at the fundamentals. Because if they have truly monopolized the safety-critical software space, I mean, that should be glaringly obvious on the balance sheet.
It should be, yeah.
A good story about a multi-year runway is nice, but to prove this isn't just a narrative, we have to look under the hood at the quality of their revenue. Like, are the actual cash flows matching this software turnaround thesis?
They are, actually. And the numbers are finally validating the story. We are looking at 4 consecutive profitable quarters in fiscal year 2026.
Oh, wow. 4 in a row.
Yeah, they've successfully arrested years of prior top-line decline. Total revenue has stabilized at $549.1 million.
Okay.
But what's really capturing institutional attention is the acceleration. Fourth quarter revenue came in at $156 million, which represents a 10% jump year over year.
Wait, hold on. A 10% jump is growth, yes, but in the software sector, growth can sometimes be a mirage.
Yeah.
Are they actually making money efficiently, or are they just burning through their cash reserves to buy market share and print a nice headline number to, like, appease the analysts?
No, they are doing it incredibly efficiently. And the primary reason is their QNX segment.
The embedded software.
Exactly. QNX is their embedded software division, and it is the undisputed growth engine right now. In the fourth quarter, QNX hit record revenues of $78.7 million.
Record revenues.
Yeah, and for the full fiscal year, it brought in $268 million. But here's the critical metric for anyone analyzing the health of this business. QNX has officially become a Rule of 40 business.
Okay, so for those who might not live and breathe software valuations, the Rule of 40 essentially means that when you add a software company's revenue growth rate to its profit margin, the combined number exceeds 40%.
Exactly.
It's basically the gold standard for proving that a company is successfully balancing aggressive expansion with actual sustainable profitability.
Precisely. And the gross margins on this QNX software are a staggering 83%.
83%.
Yeah. Just let that sink in for a moment. Think about the transition from managing low-margin physical supply chains to enjoying 83% software margins.
That's a completely different business model.
It really is. And this isn't speculative software. It's deeply embedded. It's currently operating in over 275 million vehicles worldwide.
275 million. Wow.
Right. That kind of market penetration drives real, tangible cash. The company generated $50 million of operating cash flow in fiscal 2026, and management expects that figure to double to $100 million in fiscal 2027.
The cash flow doubling is impressive, but you know what really stands out to me as a risk-conscious analyst?
What's that?
Their capital discipline.
Yeah.
They are taking that cash and actively defending the stock's value.
Yes, the buybacks.
Right. They recently renewed their normal course issuer bid, which is a formal share buyback program authorizing the repurchase of over 26.7 million shares.
That's a lot of shares.
It's roughly 4.58% of their entire public float. And they have a proven track record of executing on this, too. Under the previous program, they bought back 18.1 million shares at a weighted average price of $3.85.
Which is just a masterstroke of capital allocation when you look at where the stock is trading now.
It absolutely is. Buying back your own stock at under $4, when you, as management, know the internal software metrics are accelerating, it provides a massive tangible floor for the stock price.
Right. It protects the downside.
Exactly. It prevents dilution from employee stock plans, and more importantly, it aggressively signals to the market that management believes the equity is deeply undervalued.
That brings us to the catalyst timeline. Because having strong fundamentals and an 83% gross margin is fantastic, but value can stay trapped in a stock for years without a spark.
Yeah, you need a reason for it to move.
Exactly. We need to look at the upcoming events designed to unlock that embedded value over the next few months.
And to me, the most compelling catalyst isn't even in the automotive sector. It's their government and defense mode.
You are spot on. Their secure communications segment is benefiting directly from massive, accelerating global defense budgets and digital sovereignty mandates.
Which makes sense with everything going on right now.
Right. In today's geopolitical climate, governments are realizing they absolutely cannot rely on consumer-grade software for national security. And to prove this, their ad hoc platform just secured the 2026 FedRAMP Class D High recertification.
Okay, let's explain what that actually means, because Class D High sounds like alphabet soup.
It does, yeah.
Why is that certification such a massive moat?
So FedRAMP High is the most stringent level of security authorization the U.S. government offers. It is designed for systems that handle highly sensitive, unclassified data where a breach or a failure could result in catastrophic financial loss or even loss of life.
Wow, okay, so the stakes are as high as they get.
Exactly. Getting that certification takes years of rigorous auditing. Because they have it, Ad hoc is currently used by 80% of U.S. federal government agencies for crisis communications.
80%.
Yeah. Furthermore, their SecuSUITE platform is cleared by the NSA and NATO for classified voice and data.
I mean, the switching costs there are essentially insurmountable.
Yeah.
You do not just rip out and replace the secure messaging infrastructure of NATO or the U.S. Department of Defense because, some Silicon Valley competitor offers a 10% discount.
No, absolutely not.
The margin for error is zero.
Exactly. The moat is incredibly deep. Now, looking at the immediate calendar, we have a dense cluster of catalysts to watch. On May 27th and 28th, QNX is showcasing their real-time operating system for physical AI at the Robotics Summit and Expo in Boston.
Okay.
Shortly after, on June 2nd, the CFO and the QNX president are holding a fireside chat at the Baird Conference in New York, and then the main event. June 25th is the tentative date for their fiscal Q1 2027 earnings report.
I really want to highlight that Robotics Summit on May 27th because this ties into a strategic partnership with NVIDIA regarding their IGX platform and physical AI.
Yes.
If you are analyzing the stock, you have to consider how rotating into the NVIDIA ecosystem completely rewrites this company's total addressable market.
This is where the story goes from just automotive to global automation. NVIDIA makes the incredibly powerful chips, the brains, basically, for next-generation robots.
Right.
But a brain needs a nervous system to control the physical body.
Yeah.
When a massive industrial robotic arm is operating in a factory, or, a surgical robot is operating on a patient, it needs software that guarantees a physical action will happen in the exact millisecond it is supposed to.
And that's where QNX comes in.
That is exactly what QNX provides. They aren't just putting software in car dashboards anymore. They are positioning QNX as the foundational operating system for autonomous robotics globally.
Now let's pivot to the chart. We need to connect those upcoming fundamental events to how aggressively the market is pricing them in right this second. And right now, the chart is screaming.
It is a textbook breakout. We're looking at a massive psychological breakout from a very long-term base.
Yeah, it's wild.
U.S. shares recently surged nearly 19% in a single trading session, pushing up to $7.91.
19% in one day.
Yeah. We already mentioned the year-to-date return passing 108%. But when you look at the sheer volume behind that move, it is breathtaking. Over 57 million shares traded hands on May 22nd alone.
Which tells a very specific story.
You do not see that kind of liquidity without heavy institutional and retail accumulation happening simultaneously. The big money is officially moving in.
This is where I have to step in with some heavy risk awareness, though.
Fair enough.
Yes, the volume is massive, and yes, the breakout is technically beautiful on a daily chart, but if you're watching this 131% run, your instinct is probably FOMO-like, fear of missing out.
Oh, for sure. It's tempting.
You have to understand that the chart is currently experiencing a rapid, violent squeeze. When momentum funds stretch a stock 19% in a single day, the institutional algorithms are usually preparing to take profit at your expense. I challenge anyone looking at this chart to watch carefully over the next few weeks. Will this momentum hold post-holiday? Or is a harsh reversion to the mean imminent? Because when a stock price detaches this far from its historical moving averages, gravity usually pays a visit.
So what does market sentiment look like? If we look beyond the candlesticks, we have to analyze who is actually trading these 57 million shares and what the broader market narrative is telling us.
It is incredibly polarized. It is a tale of two cities right now.
It really is. On the bullish side, you have rising institutional flow. We've seen recent whale alerts, large institutional block trades, specifically in the information technology sector targeting the stock.
Following the smart money.
Right. We already discussed the strong corporate insider confidence demonstrated by the aggressive share buyback renewal. Plus, you have very bullish headlines coming out of the CIBC conference, and that FedRAMP certification news is bringing in defense-focused investors.
But on the other side of the trade, Wall Street analysts are largely digging their heels in. They remain incredibly skeptical of the turnaround, especially when you compare the sentiment here to other tech peers.
Yeah, they're not buying it yet.
Wall Street seems to be anchored to the historical revenue declines from the hardware days rather than, pricing in the forward-looking software margins.
There's also a highly speculative layer to the current sentiment that we have to address, too.
Oh, the M&A rumors.
Exactly. During the Q4 earnings call, management dropped a very subtle hint. They noted that their bar for action is exceptionally high. but they are actively looking at M&A mergers and acquisitions.
Which set everybody off.
It immediately sparked rumors across trading desks of a potential accretive tuck-in acquisition. The chatter suggests they might be looking at something in the robotics sector, or maybe a move to expand their secure communications footprint.
That makes sense.
If they announce a smart strategic acquisition that plugs right into that NVIDIA robotics ecosystem, I mean, that is absolute sentiment gasoline.
Now let's talk about the risks. Because ignoring the severe disconnect between this bullish retail momentum and Wall Street's skeptical reality is a great way to destroy capital.
The bear case is heavy, so let's walk through it.
The hard bear case is entirely centered on valuation risk. The predominant analyst narrative, like the consensus models that major funds use to allocate capital, pegs this stock as 92% overvalued.
92%.
Let that number sink in. They calculate a fair fundamental value of only $5.68 Canadian. Compare that to recent Toronto closing prices of around $10.88 Canadian.
That's a huge gap.
That represents a massive downside of roughly 48%. If the upcoming June 25th earnings fail to show flawless execution, the momentum crowd that drove that 131% return could violently exit. And when momentum funds unwind a position, they do not care about the 83% gross margins. They just sell at whatever the market price is.
That is a very real, immediate valuation risk. And from an operational standpoint, they face significant ongoing threats too. There is a long-term threat from open source competition.
Right.
Tech giants pushing open source platforms like Linux and Android Automotive OS are constantly trying to creep into the vehicle software space. Right now, open source is mostly limited to non-safety infotainment systems, like the screen that plays your music or shows your navigation map.
Let's explain why that is. Why can Android run my car's Spotify app, but regulators won't let it run the braking system?
It comes down to a concept called deterministic performance.
Deterministic performance.
Think of QNX as an exclusive VIP lane on a highway. When the vehicle needs to perform a critical action like deploying an airbag or applying automatic emergency brakes, the QNX software guarantees that action will happen in the exact required microsecond. Every single time.
It can't lag.
It never gets stuck in traffic behind the radio volume control. Open source systems like Linux do not currently have those stringent safety certifications for advanced driver assistance systems.
Right.
However, massive companies are pouring billions into narrowing that gap, which remains a long-term threat.
The other major operational risk lies in their backlog. We talk about this massive $950 million royalty backlog as if it is like a giant pile of cash sitting in a bank vault.
It's definitely not.
I need to be clear. It is an estimate. It is highly dependent on global auto production actually happening. If we hit a macroeconomic wall, let's say interest rates stay high, consumer spending drops, and car manufacturers stall their production lines, those QNX royalties get delayed indefinitely.
Yeah, that's a big if.
If the cars don't roll off the assembly line, the revenue doesn't materialize.
So with everything on the table, what's the final verdict?
Looking at the entire picture, the research yields a bullish score of 8 out of 10.
The clear long-term investment view here is that this is a multi-year hold. Yes, there is significant short-term momentum risk due to the recent technical squeeze. But fundamentally, the broader market is currently mispricing the stock based on legacy hardware nostalgia.
Yep, they're stuck in the past.
They are valuing a physical phone company that simply doesn't exist anymore, rather than accurately pricing a deeply embedded software infrastructure company with 83% margins.
Totally.
It is going to take 3 to 5 years for the NVIDIA robotics partnership to truly bear fruit, and for the conversion of that $950 million automotive backlog to fully mature. But the foundation is undeniably solid.
Exactly. The transition from consumer hardware to critical AI infrastructure is, rarely smooth. But when the dust settles, you don't want to be the one arguing about how good the old devices used to be while missing the software revolution happening right in front of you. Keep a very close eye on those June earnings to see if the execution finally matches the ambition. If you want to build a cleaner trading workflow, you can check out VIP Algos through the link below, starting as low as $9 per month. It includes AI-powered TradingView indicators, visual alerts, risk-to-reward planning tools, beginner-friendly education, setup support, and community access. Just remember, trading carries risk, no indicator can guarantee results, and every trade is your own responsibility. Use it for education and chart analysis, manage risk carefully, and make your own trading decisions. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.